Okay, Barb, I would like to turn things over to you for just some opening remarks, if you would be so kind, and introduce our guest speaker this evening. That would be great.
Thank you. As Daryl said, oh, by the way, I'm Barb, and I'm with the AARP Foundation Tax Aide program. And this evening, our topic is retirement and taxes. It should be on your screen. It is the fifth of 6 sessions about Ask Tax Aide, free tax advice. And tonight's presenter is Sean McPhellamy. Sean's the local coordinator in Talkeetna. And again, Sean, thank you. I know you did taxes all day at the Talkeetna Senior Center Y today. So we appreciate all the time you put getting prepared for us and presenting tonight. Sean has qualifications well beyond his tax aide qualifications. And so that said, Sean, I'm going to give it back to you to further introduce yourself.
Thank you, Urban. Thank you, Daryl. I greatly appreciate it. I'm glad to be here and glad to see everyone. And as much as possible, I'll try to answer some questions and talk about this topic, one of my favorites. The simplicity in the initial slide is just an attempt to try to keep things simple. I recognize this is a complicated and challenging situation. I won't be able to answer everything, but we'll get a little bit more into that.
And Sean, if it's all right, I'd like to just let people know that if they have a question, feel free to raise your virtual hand, raise your real hand if you're on camera. Drop the question in chat. We're a nice sized group tonight, small enough. I think we can accommodate some questions as we go along. So feel free to drop questions in chat, and I will monitor that for you, Sean. Make sure that any questions that get dropped in chat will get answered.
And I certainly welcome that and the opportunity to try to keep this both lively and somewhat entertaining. So great. And visually, just a couple of things. Well, not too many pictures in this presentation, but some of them are chosen specifically from the AARP presentations that have been helpful. I like this topic as much as I said, and just let you know. Certainly upcoming quickly, the deadline for federal income taxes is Monday, April 18th. And as the folks may need the reminder that they may request a 6-month filing extension, but the tax obligation is due as of April 18th. Again, I'm Sean. I'm glad to be here this evening, and also a certified volunteer income tax preparer with AARP Foundation's Tax Aide Service. As mentioned, glad to be the new local coordinator for the Tax Aide site, the Upper Susitna Senior Center in Talkeetna. I'm also an accredited financial counselor, might be abbreviated as AFC, and a certified counselor with the state of Alaska's Medicare Information Office. In a bit of a previous life, I served as an enlisted Coast Guardsman for over 3 decades, and my wife and I are very glad to be home here in Talkeetna. One of the goals first is just to frame where are we going to be with today's presentation. I do intend to discuss income tax related issues that may be of interest to those retirees and those who would like to retire. But first, a disclaimer, what I won't be able to do. The information presented is intended to help generally educate. This is not financial advice for any one individual's personal situation. Each of the views here are my own and do not reflect the opinion of AARP, the AARP Foundation, or Tax Aide as a whole. Possibly not surprising, very smart person said this quote. Albert Einstein was quoted in Time magazine in 1963 as having said this in a letter by Leo Matterdos. quote came out of a conversation because Leo had been doing Albert Einstein's taxes for many years, and he certainly thought that they were complicated. But also complicated is the psychology itself of paying taxes. For example, more than 90% of Americans regard it as our civic duty to pay our fair share. But therein lies the rub. What's fair? 2/3 of taxpayers believe that wealthy folks and large corporations are not paying their proverbial fair share. And almost everything beyond that gets into a conversation that's far more political in nature than I intend to get to tonight. But there's plenty of other irritants also. Tax pros, tax volunteers, and most people just have a slightly different take on what drives people craziest about their taxes. Could be that taxes are too complicated. The tax themselves may not be spent how I might want. And then sometimes the IRS can be frustrating to work with. Getting organized can be fairly straightforward, but as tax documents arrive, folks are encouraged to place them in a folder, a safe place for paper, and a digital place for any emailed documents that you may need to download online. For many people here online, they've already maybe filed their taxes, but I'll talk a little bit about how we got here, both now this calendar year and then generationally. Many people start their whole careers through working wages, and they have their annual W-2 form, which shows their employment income. They also may get a variety of different forms, and I could go through the 1099s, not elsewhere classified, miscellaneous, interest and dividends, B's and R's and G's. And then we get documents just sent from the IRS, especially as the last couple of years, with economic impact payments. All this can be very confusing to many people, and that's one of the reasons why AARP Tax Aide volunteers are glad to try to help sort it out and help people with their confusion, but also just to make their life a little bit easier. It's a great service. For those working age folks, your employer withholds money for you. We have a pay-as-you-go system. And for most folks, if you're confident, you'll take the standard deduction, which is $12,550 for single filers and $25,100 for joint filers this year. That will reduce some of your paperwork. If you're age 65 or older, the standard deduction is an additional $1,350 higher per person for married couples filing jointly. So if you and your spouse are both 65 or older, the standard deduction is $2,700 more. If your filing status is single, you get that additional $1,700 for your standard deduction. It doesn't make sense to go through the time and effort to itemize if your itemized deductions are less than the standard deduction. But as you get into retirement income is more challenging because the burden then becomes on the individual. You may need to do this yourself. There are ways that you can set aside your tax withholding with an estimator, a calculator, to enter any pension income or Social Security benefits that you or your spouse receive. There are tools that can help automatically try to calculate the taxable portion and incorporate it into an overall estimate of any projected tax liability and withholding for the year. If a withholding change is needed, retirees can choose a tax due of close to zero or a refund amount with those calculators. There are a variety of different options and links, but ultimately, tax return preparation gets us through mid-April. The rest of the year, that's a lot about tax planning and helping to understand what's going to be the challenges you might experience, especially if your situation changes mid-year. For example, leaving work, beginning retirement, or if your situation changes with unexpected incomes or reduced amounts. Putting it all together can be exceptionally challenging. One of the first is an example from Social Security. Knowing how Social Security is taxed isn't always easy for everyone, because you'll hear conversations often about their own individual circumstances. And for some, they're surprised that Social Security is taxed, but not for everyone. If your total income is more than $25,000 for an individual, or $32,000 for a married couple filing jointly, you must pay federal income taxes on your Social Security benefits. Below those thresholds, however, your benefits are not taxed. That can apply to spousal benefits, survivor benefits, and also Social Security Disability Insurance, or SSDI, as well as those earned retirement benefits. The portion of your benefits subject to taxation varies with income level. You'll be taxed on up to 50% of your benefits if your income is $25,000 to $34,000 for an individual, or $32,000 to $44,000 for a married couple filing jointly, and up to 85% of your benefits if your income is more than those limits, $34,000 for an individual or $44,000 for a couple. Again, that's for the Social Security portion, keeping in mind that if you have other income, that adds in. The Social Security Administration estimates that about 56% of Social Security recipients owe income taxes on their benefits. For purposes in determining how the IRS treats your Social Security payments, income means your adjusted gross income plus your non-taxable interest income plus half of your Social Security benefits. The Internal Revenue Service has an online tool that helps calculate how much of your benefit income is taxable. Keep in mind, supplemental security income, or SSI, is never taxable. If you do have to pay taxes on your benefits, you have a choice as to how. You can file quarterly estimated tax returns with the IRS or ask Social Security to withhold federal taxes from your benefit payment. You may choose to have your federal income tax withheld. There are different rates that are applied. And if you have questions, it's always good to talk to the person who's helping you file your income tax return to see what changes might be coming and discuss those in preparation for the following year. Generally, the goal is that you also have saved up during your working years, and now you want to withdraw money from your tax-advantaged retirement plans, 401ks, individual retirement accounts. Periodic distributions are pension or annuity payments that are paid regularly, could be weekly, monthly, or even just yearly, to the individual. Periodic distributions are subject to withholding using the same methods as wage income. You will need to file a W-4P, in this case, W-4P, to inform the retirement plan's administrator of your withholding allowances. This applies to payments you receive from, again, a pension, an annuity, a profit sharing plan, or a stock bonus plan from an employer. Most well known is the traditional IRA, individual retirement accounts, or any other deferred compensation plan. And that also includes commercial annuities purchased from insurance companies. You also can choose not to have any federal tax withheld on a periodic distribution by writing no withholding. But do keep in mind, that doesn't mean that you won't have to pay taxes. That just means that you haven't withheld the money during the year. Again, 401k plans and individual retirement accounts are the generally most common versions of these pensions, but that also includes a variety of different allowed programs for large businesses, small businesses, self-employed, and again, individuals. For individuals, one of the most important questions that they've been saving is to pay taxes now or to pay taxes later. Traditional IRAs are a tax-advantaged personal savings plan where contributions may be tax deductible. Roth plans, Roth IRAs, are tax-advantaged personal saving plans where contributions are not deductible, but qualified distributions may be tax-free. And for many folks, they think about what they have done and what they want it to become. And so you can convert a traditional IRA to a Roth IRA by completing a rollover, a trustee to trustee transfer. You also can do a same trustee transfer. But these reported gains then have to be taxed in order to convert over to that non-taxable benefit later as a Roth. This can be beneficial most commonly when your retirement income, when your income has significantly been reduced and you're currently in a lower tax bracket than especially one where you will be later in life. No one has that crystal ball, but there are some good estimates based on personal situations. You cannot keep retirement funds in your accounts indefinitely. This is where required minimum distributions, also known as RMDs, come into play. Generally, you have to start taking withdrawals from your tax advantage plans when you reach age 70 and a half. However, changes were made with what's been known as the Secure Act, or the Setting Every Community Up for Retirement Enhancement, which was part of the Further Consolidation Appropriations Act in 2020. Due to changes by that act, if your 70th birthday was July 1st of 2019 or later, you do not have to take withdrawals until you reach age 72. Roth IRAs, however, do not require these required minimum distributions until after the death of the owner. Your required minimum distribution is the minimum amount you must withdraw from your account each year. You can withdraw more than the minimum required amount. Your withdrawals will be included in your taxable income, except for any part that was taxed previously, your basis, or that may be received tax-free, again, such as the qualified distributions from designated Roth accounts. Minimum distribution rules discussed here apply to those traditional IRAs, simple IRAs, SEP IRAs, 401k plans, 403b plans, 457b plans, and other profit sharing plans approved under the Internal Revenue Code. If, however, the distributions required in any one year are less than the required minimum distribution for that year, you may be subject to an additional tax equal to 50% of the undistributed RMD, or required minimum distribution. Moving to a different topic, capital gains. And generally, the question becomes, is a capital gain something long or short? And this becomes the question really of, was the item of which capital gains were recognized a period of over 1 year or under? If short, if under a year, then it's ordinary tax rates for those short-term gains. And if over, then reduced tax rate for long-term gains. The goal with capital gains is to first figure out your cost basis. For example, if you sold stocks, bonds, or other securities in this past year, you will need to know the cost basis, or what you paid, to calculate any gain or a loss on the sale. For many folks, previous to 2011, brokers were not required to report cost basis to the Internal Revenue Service. So you may receive a document that does not have the records of what you paid, requiring you to collect that information and be able to report it. Again, if you don't use a broker, you are responsible for figuring out your cost basis. Calculating that gain or loss means understanding what was the selling price minus any allowed expenses. This equals the amount realized minus an adjusted basis. And that ultimately equals your gain or loss. There are special tax rules that apply when you sell or otherwise give up ownership of your home. If you meet certain conditions, you may exclude the first $250,000 of gain from the sale of your home from your income and avoid paying taxes on it. This exclusion is increased to $500,000 for a married couple filing jointly. The IRS publication 523 has worksheets for calculations related to the sale of your home. It can show you how to determine if you have a gain or loss on the sale of your home, figuring out how much of any gain is taxable, and reporting the transaction correctly on your tax return. Tests involved in reporting this to the Internal Revenue Service involve confirming the qualification for someone to take this reduction in taxes, confirming ownership, residence, reviewing a look back or a comparison to selling another home within a 2-year period, and a review of exceptions. Estate planning, that can be the big challenge for many folks who have to figure out what happens after a loved one passes away. Planning itself helps make that gift ahead of time for everyone else. Estates of decedents who die during this year have a basic exclusion amount of $12 million, up from a total of 11.7 for estates of decedents who died in 2021. The annual exclusion for gifts increases to $16,000 for this year, up from $15,000 in 2021. One of my favorite sayings relates to helping to give with a warm hand as opposed to a cold one. And there could be a lot of discussion about how someone plans for this, again, far beyond the scope of this conversation. But something that is important for everyone is to plan now. Documents that may help include advanced directives, which offer guidance to loved ones and medical professionals for your healthcare. Durable powers of attorney, which also are included with advanced directives, allowing you to appoint someone to make medical decisions on your behalf. Revocable living trusts. Drawn up correctly, this can make it easy to keep control of your finances, letting a trusted person step up if necessary. Probably the most commonly thought of document is a will. When you have a will, you can help head off potentially difficult family squabbles or worse by clearly spelling out whom you want to inherit things that might not be in a trust. Your home or your car, for example, if the titling of such is not already clearly spelled out. Accompanying a will may be a letter of instructions that helps provide a guide to anyone who follows your instructions so that they know what your intention was. A durable financial power of attorney. Similar to that one for healthcare, it can help provide for someone, a trusted advisor, to take charge if needed. These documents together are no guarantee, but often help to provide guidance and relieve stress when the time comes. I'd like to now open up and ask if there are questions. There's a number of things that were mentioned quickly, possibly in passing, and I'd love to hear what have I missed and how can I help?
All right, feel
Yeah.
free to take yourself off mute or raise your hand, take yourself off or put yourself on camera, take yourself off mute if you have a question, or you can drop a question in chat if you'd like. So we'll go ahead and pause here for a minute to see if chat lights up or if anyone else has any questions.
I have a
Joan,
question.
Joan, raise your hand. All right, Joan, you're up first.
Okay, so I have a 403B. I have a Roth account, and I also have traditional IRAs. do I, when it comes time to do the required minimum distribution, do I need to take that from each account?
So you can exclude the Roth because that wouldn't be requiring the minimum distribution because you've already paid taxes on that.
Okay,
For the other two, having a 403B traditional form and the traditional IRA, then each will have calculations and it's a total amount that is used by the IRS for the required minimum distribution.
okay, a total amount for the combination.
Correct.
Okay,
Understanding oh, go ahead.
well, you go ahead and then I just want to ask a follow-up.
Certainly. Well, I was just gonna say, some plan administrators do have information that helps qualify what they're going to do with your account in relationship. But you can check in with them to make sure that your intentions for required minimum distributions are known.
Okay, and could you state the birth date or the date again for the required? It sounds like you have to take it, if your birthday falls after July of the year, you don't have to take it till you're 72?
No, sorry. Yep,
Okay.
you're right. Let me try to be more clear. If your birthday was after July 1st, excuse me, I'm going to go back and read the exact statement. 1 second. Generally, you have to start taking withdrawals when you reach age 70 and a half. However, that changed if your 70th birthday was July 1st, 2019 or later.
Okay, got it. Then it's 72.
Yes.
Okay. Thank you.
Yes. No, happy, Sarah. Thank you. Good question.
And Sean, we have a couple questions in chat. This one, I think there's always room for clarification. So let's just go ahead and ask here. 401k Roths must take RMDs, correct? I think question mark, unlike a Roth IRA. Is that right?
I will have to confirm. I believe that they do not have to take the required minimum distribution while the owner is alive.
So the
I will double check that, but I will.
Okay, great. And then the next question is, so even if you are still working, you would have to start getting minimum distributions from the IRA and or 403. I'm guessing there's a B on the end of that.
So there are differences in rules for if you're still working. And I can't answer those right now. There is a difference and it involves a couple of different things. First, the IRA is treated different than the company plan, the 403B in this example, and owners of businesses with 5% ownership or more are also precluded. So there are a couple of things that come into play. I believe the IRAs, again, to be confirmed, would have to have that started. And if still working, the workplace plan may be deferred.
Okay, great. All right, I don't see any other hands raised.
Sean, I have a question. It's
Yeah, good.
our
Okay.
crazy real estate market where it's not unusual for homes to be bid up 40, 50, even 100,000 over list. Could take some taxpayers over that 250,000.
Yes.
So can you talk to us about what goes into the basis to maybe mitigate some of that markup that's going on in crazy real estate market?
A little bit, but again, the IRS guides this process more specifically. The largest number of bases becomes the purchase price. So the selling price less the purchase price is the gain, and the purchase price is the basis. However, there are some examples where additional improvements to property, not maintenance, but improvements, can increase basis. An example might be, I've a home that I then added onto with a fixed garage on the physical building. It increases the value and increases the structural capability. It's a significant change to the home. It would change the basis. A paint job is an example where it would not. That's more maintenance.
I believe putting a roof on, though, for some strange reason does increase the basis.
I don't disagree, and I know that one, but I would check the rules without in order to confirm.
I've got another question on the $250,000 and $500,000 deduction on a house. What happens? And I've run into this with clients. One person was really sick. They were married, so they're getting ready to get that $500,000 deduction if they're still married. But if one person dies during the interim, it's my understanding then the next year they wouldn't get that. They would have to sell the house while the person, in the year the person died. Is that your understanding, or have you looked into that?
I do know that there are widower allowances. What I can't confirm without looking up the rule is when that expires. I agree with you, Ron, but I can't remember without looking it up.
Yeah, it seems kind of confusing and unfair to me, but IRS isn't always fair about things. So, or what I should say, the IRS Congress.
Yep, and a long conversation at that point about fair.
Sean, one other question, and they're coming from taxpayer experiences. The rollover to a Roth is a taxable event, correct? We've had taxpayers get caught off guard rolling to a Roth, even though somebody's recommended it. They don't recognize that they have to pay the taxes.
Correct. And so a traditional IRA rolled over to a converted is a more proper term, rollover itself, but that conversion over to a Roth form changes the taxability. What was saved previously in taxes has to be accounted for in some fashion. And so that comes to add to someone's income. And if you're doing this at a point where you're at a normally high income, you may be significantly higher in income, and it may change your tax bracket.
Yeah. Something else to think about, so Medicare too, when you do that, you got to be really careful.
Correct. And so what Ron's referring to is the income related monthly adjusted amount, and that IRMA can significantly change because there's a 2-year calculation that does come into play. There are some allowances for life-changing events. However, the assessed IRMA often hits first, and then you have to, I won't say fight, but request a life-changing event appeal.
And I was also the one that asked about the Roth and also the Roth if it's a 403B or a 401k. My wife was actually a long-term employee of Providence. They were doing 403Bs. They've now converted them all over to 401ks for whatever reason, I don't know. but my understanding they're kind of the same thing. And when I checked into that, my understanding was that the Roth in a 403 or a 401k would have to have MRDs taken out. However, if you rolled it over to a Roth, it would, an IRA, it wouldn't. So as soon as she retired and she went registry so she could do this, we rolled every penny over into an IRA. And that might be the smart move for anybody that can do it.
Correct. And I don't know, as I mentioned, the rule, but if, as you mentioned, either a fixed plan, a company plan, 401k or 403b, as a Roth component, if that is that rule, the rollover then to a Roth form of an IRA does change the rules. And so the Internal Revenue Service code spells all that out. And that's why I don't want to answer until I check.
Got it. But if that is correct, once again, why that ambiguity? Who knows?
I noted.
And a lot of people, I've been dealing more than a few people don't understand the 5-year rule either about IRAs or Roths. You have to be in any Roth anywhere for 5 years, and then it qualifies.
Good. And there's some, yes, as long as you've had a Roth, then that can build your 5 years in as you expand it later.
Always advise younger clients, put $100 in like Fidelity in a Roth IRA when you're in your 20s and just be done with it.
Not disagreeing. I yes.
I think, Sean, too, one of the things that you touched on are goals in retirement. You have goals for yourself, and then you have goals on transferring wealth perhaps to your kids. And they can have, you can go at things differently based on that goal. The gifting ahead of time. I loved your warm hand, cold hand. Gifting in advance, Roth, where they're taxed on the earnings, because I think there's probably an evolution happening in inherited IRAs. So we don't know how our kids are going to get taxed on inherited IRAs at this point.
Correct.
Are
And
they
so
gonna have to dump it all out of inheritance, and I'm not putting you on the spot for this because I don't know that there's an answer. It's still in legislation.
and variations of your mileage may vary. Each situation can be its own unique situation. However, there are some generalities, one of which is the tax rules changed, as you mentioned, or the 10-year rule for other than a spouse as transitions. Those can be significant, could change someone's tax situation if all of a sudden they're having additional earnings, additional income that they did not expect or recognize early on in planning.
All right, still just want to give everybody opportunities if they have any last minute questions. I know we're approaching 20 after, but we do have time. So if you do have a question that you'd like to ask Sean, feel free to raise your real hand, your virtual hand, take yourself off mute or put yourself on the camera. I don't see anything in chat and I don't see any other hands raised. So Sean, I think you've done it.
Well, I tell you, just threatening people with 10 hours was probably the good goal.
Right. Well, everybody hung in there. So the 10 hours didn't scare too many people away. So
can I just confirm, is my slide up for my name and number?
it is. We can see your name, your email, and your phone number.
If there's something I can do to try to help, I will, but keeping in mind, I, again, am not a real estate lawyer, not a professional in that regard, and certainly not a CPA. But again, happy to try to answer and help people with where they can seek those answers and obtain additional guidance if needed.
Great. Well, we do have some thank you comments coming in the chat. So I'd definitely like to echo that, Sean. Thanks so much for being with us tonight. Thanks for staying in with us. I'm sure it was a long day for you. And I don't know if you ever get tired of talking about taxes, but you don't appear to. So that's great. So great to have you with us. Thanks again for being there with Tax Aide. And thanks to all the other Tax Aide volunteers who have been on the call, the presentation with us tonight. We do have one more presentation coming up on April 13th. It's virtual presentation number 6 in our series. What do you do if you can't pay your taxes? What do I do to plan for next year? So, and I would imagine that there will probably be some questions like, what do I do if I haven't even started the process? And it's due in 5 days. It's due in 5 days. So for those procrastinators out there, we are there for you. That's for sure. But again, Sean, thanks so much for sharing your time with us tonight. I really appreciate it. And thanks to everyone for being with us. Look forward to seeing all of you at the next event. And you can always register at aarp.org/AK under upcoming events. So with that, I would like to wish everyone a great evening, and we'll see you all next month.